Greetings, Dr. Jeffrey Scott here. This is my weekend market update for October 20th, 2024. If you have any need to contact me, my email is there for all to see, hgsidoc@gmail.com. I can also be contacted via the remarks section in YouTube, where I'm happy to respond to constructive criticism, positive and negative, or any questions about the tools that I use. Just a little warning, I'm on a cruise ship, which means I've got cruise ship internet, which means God only knows what will happen as we go through. Stocks were up this week despite gold at an all-time high, dollar rising. Yields didn't rise this week. They're mostly flat, but they've been rising the last several weeks. Bitcoin is rising. Sometimes when those things are up, you don't expect the market to be doing well. So let's take a look at what we see and try and prepare ourselves for the week that's about to come. As always, this is for educational purposes. Only anything I might mention should be taken as education and not investment advice. I've got all kinds of licenses, but they're to practice medicine, not to tell you what stocks to buy, nor to help you manage your money. I'm independent. I have a number of tools now in the market that have been created for me by third parties, whether it's the awesome CAT scanner in Wealth Charts by Rob Hoffman and crew, whether it's the TradeStation tools in the Epic Trading App Store by Van, whether it's Praveen, who's created tools in TradingView, whether it's upcoming tools for Metastock, and lastly, an upcoming integrated tool from Praveen and I that's freestanding app. So I have a number of tools out there, and I have relationships with the developers, but really don't have anything more than just relationships on the tools with any software company. Trading involves risk, and you are solely responsible for any investment decisions you make. If you like this, I do a daily video when I'm not on a cruise ship at stocksanddocs.com. It's usually 5 to 8 minutes long. When the market's undergoing changes, I talk too much and it's a little bit longer. I always start to look at the major markets to get a sense of what's going on. So if you look here, in yellow are the major indices. In green is 5-day performance. In here, and then the second column, 1-day performance. You can see mostly green. It was a strong week. In fact, when you look at the major indices, they were all up, led by small caps. When you look at Friday, small caps were actually down a bit, but on the week, small caps were up 2%. When you look up at the top, you can see the overperformance by Bitcoin, by silver, and even ARK Innovation. Kathy Wood had a good week, up 3%. Volatility on the week, or short, the volatility was actually up 2.7. So volatility was down a bit on the week, and gold was up. So we have a lot of things moving higher, including the dollar, which was up 0.7, and the major indices. Now, things that are moving lower, commodities with the dollar stronger, oil, natural gas really were down a lot on the week. I also want to point out here the dates of the 52-week lows. We're about to lap them. So a week from now, we're going to start seeing the 52-week low dates start to push out every week because we will have passed them. So if you look at the 357, 358 trading days since we set those lows, look at the one-year performance. This is not about 7 stocks anymore. This is a broad base, whether you're looking at the Qs up 44, the NASDAQ in general up 47%, the SPDR is almost 43, the NYSE up 36, Diamond's up 34, and the Russell just under 40%. So we've been part of a rip-roaring, stealthy at times, unloved at other times, bull market. If you look at the 5-day performance that we've had, led by utilities, real estate, and financials, clearly some rotation out of technology. You know, we know about the ASML earnings and projections forward that suggested slowing in the semi space, and then Taiwan Semi followed the next day with bullish. So a little bit of a mixture in the semi space. And we have to keep in mind that not all semiconductor stocks and companies are doing the same thing. The other thing here is if you look at the last year or so on sectors, you could see broad-based strength throughout the S&P 500. This is a Q Edge tool, and it gives me a lot of information. In the left, it shows me that 72% of the stocks in the S&P 1500 are above the midline of their Bollinger Bands. A little bit weaker than one day earlier, but still that is a bullish number. And I look down here, I see that 11.8% of stocks are above their Bollinger Bands, and I know from experience that that's extended, but I don't get too upset or nervous or worried to 25 or 30%. I don't typically get a signal at that level. If we look at performance at the sector, industry, and stock perspective, it was a 50-50 week, or a 50-50 day on Friday, a very mixed day. Down here, we can look at the week, and we can see on the week, 82% of sectors were up, 81 of industries, and 71 of stocks. So it was a positive week in the U.S. market. In fact, not only was it a positive week, it was a positive 2 weeks and a positive month. So hopefully your returns are reflecting that, but it has been a very bullish last several weeks, despite going through tough parts of September and October. Here is the Q Market Breadth tool, which incorporates a lot of the different breadth indicators popularized by my mentor Ian Woodward, among others, that I talked about over the last several years. And really the only thing that we saw this week in the market was bango on the combined NYSE and NASDAQ that occurred on Monday, which showed some exuberance. But really, if you look at the week, it was kind of flat. And when you look at the combination of the NYSE and the NASDAQ, you could see that the number of stocks at 3 months, new high, new lows, actually decreased. And the formula for this is the number of new highs over new highs plus new lows. So in a very, very strong market, you're going to approach 1, the top, and in a very weak market, you're going to be at the bottom. And I found over the years that when you get into the top area, you typically get either a flattening of the market or you see some of the major pullbacks come in. So to me, it's been very useful. Up above, you have stocks above the 50 in yellow, above the 200 in white, and the 50 above the 200 in red. And you could see they're above the midline, reflecting a bullish market. And you could see that you've had an abundance of new highs versus new lows. The only signal in the last 5 was one accumulation signal on the NYSE. When we look at and that actually was 6 trading days. The NASDAQ versus the NYSE, you could see that the NASDAQ is a little bit less extended on the 3-month than the NYSE. That bango was in the NYSE. And we had a recent unconfirmed Hindenburg on the NASDAQ. If I look at the broader indexes, you could see, again, and I won't say stalling action, but if you look here at the S&P 500, it's sideways on the 1500, kind of sideways on the 100 NASDAQ, sideways on the Russell 2000, and even sideways the last couple of bars on the Dow. It's almost as if the market's waiting to see something. Are they waiting to see further data? Are they waiting to see the impact of the quarterly earnings, which started in earnest with Netflix and Intuitive Surgical this past week and come on like a storm, especially for big cap tech this week? Are they waiting to see if the Fed cuts and how much the Fed cuts? And in that vein, this week, we have a number of Fed speakers. Now, I like objective. I like a model that once the week ends, because it's a weekly bar, does not repaint. And what we've done in our trading app is we took the same tool that we have in Wealth Charts and you can create in other programs, and we actually put the green and red buy-sell indicator at the bottom of the chart. Why? Because now you can take a look and ask yourself whether in green are you in most of the bull phase, and in red are you out of it, or is it not a helpful tool? My goal is to be in the market as much as I can during a bull run, and notice we've been in the spider since November, and during a pullback, especially a significant pullback as we saw in early 2022, to be out of the market. So you can get a visual representation. This is the weekly markets, and this is the daily. And in each of these, the 4 ETFs that I follow are in buy mode. I've also reproduced that 13-week new high, new low here. And the only one that was dangerous was the diamonds, which is up at the top. Now, the rates have been rising. On the left, you have the 10-year, the right, the 30, and you could see this rise in rates, which has been accompanied by a rise in markets. You don't always see that. And you could see that this week, the 10-year was flat, and the 30-year actually came in a little bit less than 0.07%. But the markets have been moving higher despite what were rising rates. Do we have a recession in our near future? The over-under is yes, 100% we have a recession in our future. I just don't know how near it is. If you look at the 10-2-year yield curve, we have corrected. If you look back to the 80s, once you correct, you get a recession that occurs after you correct. So yeah, we probably have a recession coming sooner than later, and I've thought that it's likely not to happen until after the inauguration. And if you look over the 10-3 month, you can see we're improving, but we still haven't closed the gap in the inversion. Now, things that tell me we don't have a problem today, if you look at the high index yield option adjusted spread, no spike here. You see spikes at times of recession and difficulty getting money. And if you look at the Fred Philadelphia Diffusion Index, a measure of economic activity, it's actually spiked up above zero. So we have too much economic activity and not enough credit tightness for me to be worried about an imminent recession. But, again, we always get them, so you're probably better off saying, yes, we have one coming. But in this case, I don't think it's tomorrow. I don't think it's until after the election, and probably not to after the inauguration. So breadth on the short-term, stocks above the 200-day, stocks above the 40, both turned up. And these are at levels that we have seen markets reverse before. And you could see in the granddaddy of the 3-month or 13-week new high, new low. I call it the granddaddy because I've been using this T2121 in Warden for 20 years. You could see that it's pulled back some, which takes a little bit of the pressure off the market. Now, what was working this week? This is part of my new trading app. I've ranked them by 5-day change, and you can see utilities, real estate, and financials. It's good to see financials there. Just you're not usually going to see big bull runs led by utilities. You could see the weakness was energy, healthcare, and then technology was rather flat. Down here, you could see certain themes. So uranium, silver, gold, data sharing, home construction, cannabis, fintech, metals and mining, retail were some of the strong themes. And what I've tried to do here is create a real-time dashboard that will update during market hours and give me a sense of what's leading. Now, I showed you in Sagar's tool where he breaks out sectors, industries, and stocks. So we built a similar monitor for that here, and we go deeper than just the S&P 1500. We can look at the NYSE, and we can look at the NASDAQ, and get a sense of how things are doing, how they compare to the prior session. Now, you'll notice that everything looks like it's in the middle. Stocks above on the S&P 1500 is higher than it is on the NYSE and the NASDAQ, but no real signs of massive exuberance, kind of a, as I called it earlier, a 50-50 day. You look up here, you can see the new highs and new lows. Again, these are updated real time during the market session. As long as we keep seeing a lot of new highs and not a lot of new lows, and that net remains triple-digit greens, hard for me to see this market cratering except for 1 or 2 day pullbacks. And then if we look over here, we could see, as I mentioned before, the Russell was the only thing down on Friday. And if you look at the closing range, you could see the Russell closed near the lows of its session. The buckets, this is from EdgeRater, 71% above the midline of their Bollinger Bands. That's bullish. Not enough sitting at the top here for me to be concerned that we are extended. Now, we've recreated the buckets in the new app. And again, I'm looking at the NYSE, NASDAQ. I'm looking at the Russell 1000 and the S&P 1500. And this gray bar represents yesterday's position, the green bar today's. I can look back a week, but I find that less helpful. And if anything, when I see gray above green to the right, it tells me that we actually became a little bit less extended on Friday and really not much going on in the lower part of the Bollinger Bands. Most of the stocks are above, but not extended. We remain in what I call Hindi watch. Why? Because we had confirmed Hindis as recent as October 9th, which is only 9 calendar days and probably 7 trading days ago. So Hindenburg omens occur preceding all major market corrections going back to the Great Depression in the 30s. 1 out of 4 is meaningful. The others can be minimal pullbacks. So I also look, and what's impressive here is we have no new lows. And typically when these things are working and telling me the market's in trouble, the new lows start to grow. In fact, you look at the NYSE and you've got 11% of 52-week new highs. So markets don't show that they're imminent. Although we are extended at the markets. We've had a beautiful bull market. We're up 40% off the lows. You have to expect corrections to happen, and you try to use this type of data that I'm showing you, the breadth, the buckets, etc., to give you insight if it's imminent. Looking at the EdgeRater warehouse report, where we break up stocks by ERG, combining EPS rank, relative strength, and the group rank. All this data is from the prior Friday. Then we march it forward a week in the market, and we could see for the most part, markets were up. I always throw out the tail and the head because there's very little stocks. And so growth actually seems like it did better. But when I look down here, there's no relationship between performance and earnings per share. Relative strength, yeah, it helped if you were strong, but it was also pretty good if you were weak. And there was no relationship to the prior group strength. If it was all driven by group, then these bars to the right would be higher. And this is interesting. Stocks that were distributing the prior week with accumulation distribution ranks of D and E actually led on the week. So another week of rotation. News and earnings will drive this week for sure. All these arrows on the left are Philadelphia Fed heads speaking, various Fed head speakers, not just Philadelphia, I'm sorry. What do we expect them to say? Let's think about the last couple of weeks of data. Unemployment, better than we expected. All right. Inflation data, some better, some worse. Retail sales, better. If I had to guess, we're going to hear a lot of we're data dependent. We have not baked in any predetermined easing, and we will look at each month, each Fed meeting on its own with data dependency. I think they're going to walk back anybody who still thinks we're going to get a 50 basis point cut. And, they could even say things that we may not get a cut in every meeting. So I think we may learn a lot from them. On the data front, we get some leading indicators. We get the beige book, some home sales, PMIs, and some durable goods and consumer sentiment. So there's some economic news, but if I was to rank the three things on this sheet, I think number one is earnings. As you could see on the right, we got massive earnings this week, and we've got the big boys. We've got Verizon. We've got Boeing. Boy, they're having some challenges, aren't they? But we've got Tesla. And then on Thursday, we've got some airlines and UPS, Skechers, Centene, another payer. So we've got a pretty busy week. And then the following week, we're going to get a lot of those big cap tech names. So we're in a busy earnings season. Second thing is probably driven by the Fed speakers. I think the data is important, but maybe this week it's in third place. And I always remember this quote that I made 20 plus years ago. A lot of people talk about when do they hold going into earnings, when do they sell, what's conviction do you have? And it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So another winning week. Semiconductors were pulled down by ASML. Taiwan Semi did mitigate some of that. As I said, perhaps the Fed won't be as aggressive in cutting. And then the underperformance of the NASDAQ and semis still was a good week for the bulls and for growth investors. Intuitive Surgical and Netflix were both handsomely rewarded for their earnings beats. And as I mentioned a couple times, we got a heavy week of earnings coming. I remain long. Long does not mean ignorant. Long means I have closely watched positions with stops in place. My theory as we run up into the election and maybe into the end of the year with only minor corrections, I think that 6,000 could be a magnet. But I'm not going to go all in on margin here. I think there's too much unpredictability with that election coming. So I'm long, have little cash on the side, out of margin, stops are in place, and I'm sitting on a cruise ship, 12-hour different time frame. You better believe I have stops because I'm not going to stay up all night to watch every stock. But I am long, and I am expecting this market to continue to go higher, at least until 9:30 on Monday morning when I'll reassess. So let's go take a look at the charts and how I get to these opinions. I'm going to use wealth charts predominantly in this session. I do have a lot of programs with my tools in it, and the analysis would be the same, whether I was using the trading app that we've created with Praveen, the TradeStation tools, the Metastock tools, the wealth chart tools, and the HGSI, which all began. Not much difference in how I use them. It's the same basic analysis. So I like to draw this horizontal line at the close on the prior week and look at how we performed on the week from that close. And we did good. All right, that's cool. Monday, gap up and a move much higher. Monday was the highest close of the market for the week. All right, so what happened after that? Well, Tuesday, not so good. Tuesday, we sold off hard, and we had the lowest close of the week. And then again, a rally Wednesday and Thursday. And really, for the most part, although we pulled back at the end of the day Thursday and gained Friday, kind of sideways Thursday and Friday when you look at the overall movement in the market. But we closed very positive compared to the prior week. Very positive on the chart, but only about a 1% move on the spider. Now, I like to sometimes throw on the other ETFs, and we could see that the small and mid caps led on the week, blue and purple, and the Qs are the ones that lagged. And then you could see the S&Ps are the bar charts, and that means the light blue, I believe, is the diamonds. Let me just prove that to me. The diamonds are the red, magenta, so that means the light blue is the Russell? Yeah, the light blue is the Russell. All right. Now we can look at the daily S&P. We broke above this trading range. I thought I killed this, which I believe was prior highs. And we set a new intraday high on Thursday, but closed down from the open. Spinning top on Friday, up 0.38%. And I believe, let's see, the close was 584.59. The close here was 584.32. So nominally, we set a new closing high on Friday. So a lot of bullish happiness here that you could see. Again, sideways move up here. We've done that before, and we broke out to go higher. Little consolidation is never bad. And if we look at the weekly on the S&P, beautiful candle up 0.86%. If we look at the Q daily, a couple of different things. We're not at a new high on the Qs. We're riding up this wave of divergences, and we've got another one showing here. So that is something that might be concerning to some people. Again, well off the high, kind of putting in a little bit of a wedge here when I take a look at it. And Friday was a little narrow green bar, which was up 0.66. And if we look at weekly on the Qs, let me throw a weekly up here. You could see weekly, we didn't do a whole lot, was up 0.22%. Diamonds on the daily, a lot like the S&P. Closing here at 432.64, prior closing high 432.45. So a nominal new closing high on the diamonds as well. And if we look at the weekly on the diamonds, you could see a nice candle up 0.91%. And lastly, the Russell. And if you think about the diamonds and the spiders, have nothing above them, no overhead supply, no resistance. The Qs, the Qs have to deal with the fact that they do have some of this. Let's take off this, hold on a second, put this back to daily. The Qs still have to take out their prior highs, but they're not that far off. But then you look at the Russell, and this guy's going to look different, because the Russell, the all-time high was November 8th, 2021, so it hasn't hit it for a long time. At 244.46, it's still 10% higher than we are. So the Russell's perhaps giving us a little flag here after this run up, and you could see on Friday it was down 0.21, but if you remember from the beginning, it was a great week for the Russell, and it was up another 2%, as you could see right here, 1.98. Hard to say anything negative about the major market indices. They look pretty darn good. If we look at the VIX for the week, you'll see the VIX was actually down 4.3%. It had spiked a little bit the prior week in the beginning of the week and then sold off with a shooting star and another shooting star-like candle this past week. And then one thing that might be concerning is the strength in the dollar, which is sort of why I called that out in my initial title. Typically, if we have a market where the dollar has been up this many days in a row, it's not great for equities. And I scratch my head a little bit here. Why? And maybe it's because the dollar's off of its prior highs. But it did break through the 50, and we'll have to see where the dollar goes. Now, if the dollar's up, not only should it be risking to the market, but shouldn't it hurt gold and silver? And if we take a look at gold and silver, you could see the one thing that they're not being done is hurt. Gold all-time high, up 1%. Silver, I also believe, all-time high with a massive move of 6%. So precious metals are certainly doing well. Oil, on concerns both about supply, as OPEC is going to be reducing some of their restrictions, and also on utilization as people keep reducing the forecast. Oil was down considerably on the week, but down another 1.7%. On Friday, on the week, you could see oil, there's a reason why energy was the laggard, sort of looks like an evening star formation here, down almost 8%. Pretty brutal day for oil. Now, natural gas, I just love technical analysis because every time this thing runs up to the 200, it fails. It failed here. and it will remain unloved by me until it gets above and holds above that 200-day moving average. Now, I mentioned that the 10-year was relatively flat on the week, and I guess you could say this entire area is relatively flat with consolidation, but the 10 years moved up 10% off of this bottom. So dollar strong, 10-year strong, gold strong. It confuses me a little bit how stocks are strong, but they are what they are, and right now stocks look pretty good. Now, breadth, the equal weight versus the cap weight, 50-50 on both the spiders. This is semiconductors and pretty much on the Qs as well. So I think the massive outperformance by a narrow group of stocks is long gone. Down here, you could see 50 versus the FANGs, and it's gone sideways. The FANGs are doing still, some are still doing okay. They're mixed. And the 50 would be great to see it start to recover, especially if you're a IBD cancel type of investor. Another thing I look at is the IEI versus the high yield, looking for spikes, which might occur during periods of economic risk. We look pretty flat down here. And then up here, I'm looking at TLT versus spider, and why would I do that? I'll show you why, because if we have recessions, and let's just put this into a month, that is on a monthly chart. You could see during periods of recessions, here's 2020. That was a strange recession, wasn't it? Over quickly. Here's 8, 9. You see spikes. There's no spike. Bonds are still underperforming stocks. If I go and I look at the gamma charts, you want to see the moving averages above. You want to see these prices above the moving averages. You want to see these things fanning out and the shorter ones starting to move on top. And whether I'm looking at the spiders, the diamonds, the Qs, or even the Russell, the multi-moving average analysis is still very bullish. I look at the hourly sectors as a tool to give me a sense of what's working now in the market. Ignore the lower left, that's Bitcoin. This is not sector charts. These are charts looking at the ratio of an individual S&P 500 sector to the spider. And if you want to find strength, find the things that are pointing to the upper right-hand corner or things that have blue bars at the end of the last session. So you could see over the last several weeks, the champ has been industrials, and it's still leading from an upper right-hand corner perspective, although it's starting to get a little bit choppier than it was. Financials have been improved some as well. Healthcare still dead. Discretionary's picked up some, especially compared to staples. And I guess I could imagine there's something going on with real estate there. But, we've been in a rather, I don't want to say quiet. I mean, there has been a whole lot of change in this, except technology goes up and down. Right now it's above average. But industrials, financials have been strong. It'd be interesting to see if real estate's going to come up. I could tell you when I did my bottoms-up review, I saw a lot of real estate stocks that looked interesting, REITs, etc. If we go into the scanners and we go to the heat map, and I like to start by looking at the big mag stocks. So first, when I look at the heat map for the S&P, despite it being a good week, it's kind of a mixed at best here. Apple earnings are coming probably in 2 weeks. I don't have the exact date sitting in front of me. You could see Apple sort of breaking out here. I'm almost wondering, are we getting to a new closing high? See, the weekly close was 235. I'm thinking that perhaps we just set a closing high on Apple, certainly in the right place, even though it was a red candle. Looking at the weekly, it's a lot more clear. But Apple, is this a new breakout from trendline resistance? Kind of looks just like NVIDIA. Something to watch coming out of a squeeze, not extended, relative strength and OBV look good. Here's NVIDIA. Similar pattern of breaking out from trendline resistance. And this is the oops from ASML and then the recovery from Taiwan Semiconductor closing just off all-time highs. Now, are we in the double top here, or are we going to break out to new highs? I'll take the latter, not the former. Netflix, great earnings and rewarded. Interesting, going into earnings the day before, which is the day earnings came out, it was actually down 2%, and then the next day was up 11%. Great earnings, you could see gap, volume, breakout, and momentum coming out of a squeeze, relative strength and OBV, super strong, not extended. A lot of people come up with estimates here in the 900s. And if you look at earnings, you want to know what's propelling it. 540 versus 512, their subs look good, and they seem to be taking share from their competition. Tesla, a red box. Tesla is broken down below the 50. I don't think Tesla's dead here, but I probably wouldn't be entertaining it until it got back above the 50. Amazon, all these stocks have earnings coming. Tesla, I believe, is this week. You can see here with Amazon, looks to me like you could probably be drawing something here. I draw too many trends. We'll see whether there's anything there. Oh, let me pull this up. Hold on one second. Put that up here. Move this thing out to here. And it looks to me like we got a wedge forming here on Amazon, and we'll see whether earnings takes it out the top to a fresh breakout, and then it looks like Apple and NVIDIA taking out this trend line, or does it come back down and test the 200? Meta, one of the big leaders, a little bit of consolidation here, not too much going on. It's pulling into the 17 range. Microsoft, this one has been lagging, and I guess similar to Amazon, look at it's the 17, the 50, and the 200 are all coming together. Boy, what a great setup going into earnings for, another thing that's probably sitting in a triangle type of a pattern. So I'm not sure I would be touching this going into earnings. It's not really giving me a great setup. What else do I want to look at? This is the one that just baffles me. It baffles me because of the fundamentals, where it's got growth rates in the single digits and a PE of 50%, but from a category, it's a killer. In the same group, BJ's was looking interesting. Let's see if we'll get BJ's here. Is this thing getting ready to break out? It showed up on my scan, so it had a breakout bar, relative strength, okay, OBV not there yet. So that's most of the FANG stocks. Here's the Google. Similar to Microsoft, kind of figure out what it wants to be when it grows up. So strength, certainly Apple looking like it's getting ready to do something. NVIDIA, both of which have broken out above these trend lines. Netflix, really a nice story. And the other stock that looked a lot like Netflix on Friday was also an earnings play, and that was Intuitive Surgical. Now, I had some major surgery this year, and as a physician, I used to think that when a hospital advertised that they had robotics It was a marketing tool. In fact, in the early days, I still think it was a marketing tool. But I had major surgery when I did my medical training, which was in the dark ages, I'm aware. It's the kind of thing that should have put me on my back and out of work for 4 to 6 weeks. At the end of the first week, I was on calls, and by week 2, I was in the office full time. And I really think that the driver of that, frankly, were the robots. And you could see here on Intuitive Surgical, 12% beat on its earnings, 4 dots, gap, volume, breakup, momentum, out of a squeeze, PSAR, bongo reversal rather, relative strength and OBV look good. Is it extended? Look how far away it is from the 200. It is 100 points, so it's far away from the 200-day moving average. I think it's something you've got to be aware of, but boy, what a great move on Intuitive Surgical. If we look at the wealth scanner, we get a sense of what's working as we go into the end of the week, going into the new week on Monday. And I like this tool. And each of the programs that I work with have different ways of doing this. And you could see, I mentioned financials from the ratio charts. You could see KBE, and KRE right up at the top with 850 perfect scores. Uranium has been strong. Interestingly, pharma has been strong as well. FinTech, silver, transports, 500 value, Russell value, core dividend growth. Look at these. These are all above 800. Financials, capital markets, insurance, mid-caps, value, computer software, and the Russell mid-caps. So a small and mid-cap rally, value rally, very different than we were 6 months ago. So this gives me a sense of what's working. I like to buy pullbacks in an uptrend. So I have built a couple of scans within Wealth Charts and the other platforms that enable me to find the stocks that are doing the behavior that I'm looking for. So I call my tool CAT Scanner. And in the CAT Scanner, I've put some of my favorite indicators. Let me just reformat this, and then I'll go through and talk a little bit about what they are and how I use them. All right. The bongo is a trending indicator. What I have the scan set up is to look for stocks whose weekly bongo is green, and then they have, in the last 9 days, the bongo daily has turned positive. So if we look at something like Boston Scientific, big uptrend, and you can see the weekly bongo here has been green for some time, a pullback, and a breakout. So the bongo pattern gives me this little pullback. The dots represent the bullish or bearish signals that I'm looking for. And I am not very creative in names, so they're more descriptive of what they do. A gap, big volume, a breakout, or momentum. The more dots, the more interested I'm going to be in the pattern. I look at the squeeze, popularized by John Carter, when the volatility of an instrument comes out, it's trading sideways. Typically, the moving averages come together, and you don't know which way a squeeze is going to resolve, to the upside or to the downside, but typically when it resolves with power. So I like to look at squeezes. Here's my daily bongo showing the reversal to green. This is my high-low oscillator that describes whether or not we're extended or not. You can see I've got it numerically listed here. This is compared to the spider relative strength. Spiking up tells me it's got much more relative strength than the S&P. And this is looking at on-balance volume. So these are captured mostly up here. The EMS is these triangles, which is a very short-term buy-sell indicator. So Netflix we looked at before, but similar to Intuitive Surgical, you can see the volume. You'll be able to see in a second the 4 dots. And this is the downside of being on a cruise, coming out of the squeeze, less than 95, so I could still buy it on the high-low. Relative strength and OBV are strong. So let's start by looking at financials and see if anything on the financial list that I've built comes up as attractive. All right, I always rank them by dots. So Sabra Healthcare. So healthcare REITs pay a dividend. OHI is another one here. And the nice thing about medical REITs is typically the tenants are medical practices. They are much less volatile than many other retail establishments. Often they're buildings that have been bought from the physicians themselves, and they enter into long-term agreements. We sold multiple ones for my practice in the day. So here is a huge uptrend, the pullback, and now the breakout, volume breakout momentum. Relative strength and OBV look good, not extended. I think it pays about a 4% dividend. Not perfect because it really reversed, 7, 8 days ago. But you could see when it's pulled back, and it's done this before, it gets a nice run. So this is the pattern I like to see. Omega Healthcare Investors, I think, has a bigger dividend. Beautiful uptrend, a pullback, and then a breakout. Now, let's take a look at that daily bongo when it pops up, and you could see that it reversed on this day, so it was 4 or 5 days ago. And again, not extended, relative strength and OBV look good. All right, I could deal with that. A lot of these mortgage companies that pay big dividends, and I don't understand these companies at all, were showing up on my scans this week. Here's one called AG&C Investment Corporation. Nice uptrend. You could see the big pullback. Pays a dividend. Again, relative strength and OBV look good as well. Just looking at this to see if any of the others here are ones that, Simon Property Group. Department stores dead? I don't think so. The shopping centers, doesn't look like it to me. Now, it's not in a pullback, maybe a little micro pullback right here, bigger pullback back here, which is when it got the signal, but it's run a little bit. This one also pays a nice dividend. So what's happened here is my program has pulled these out as potential opportunities. Blackstone, all right. I must have been meaning something there when that was highlighted. But typically when you jump like this, you don't see them go straight up. You get a little bit of a wiggle before it moves higher, a little bit of a pullback. And I think that's what that was trying to show there. So yes, some of these stocks look interesting. Kite Realty Group, another stock. And this one perhaps is, I won't say anything's perfect, but a pattern that I really like because this one has not run away from that 50 yet. So uptrend, pretty significant pullback, breakout momentum. Here's a flip of the bongo, not extended, relative strength and OBV look good. I really like KRG. All right, so that was some of the overall financials. The only bank that looked there was Comerica. Do I have other banks? Let's see, regional banks. I thought I had a banks one. Let's look at regional banks. There's Comerica. I have a lot of affinity for them. They're the ones that gave me my loan to pay for medical school in the 80s. Long time ago. Big uptrend. Not much of a pullback. I guess the pullback was over here, but it's already ran too far for my taste. All right. Insurance stocks. These things have been really good, but I think most of them have run. Let's see if anything makes it to my list. Just these two, Berkeley, WR. Yeah, these have run. Now, how do I know they've run? Because they were on my list last week. And if I go into rockets or momentum. Let's just look momentum up. I would have thought more of these would have made it to the list. They did not. All right. Go back to pull back on uptrends. Another thing I like to do is just to go into the large list of stocks. It's called my combo leaders. I do a lot of work on Friday night and Saturday morning looking at 1,000 charts. And these are the 1,000 charts I looked at, and I'm looking for signals to pay attention to them. So here are ranked by dots. Back to my pullbacks and uptrends. Silver core, gold and silver, my God, do they look strong on Friday. Here's your pullback, a big gap up and breakout on Friday on silver core. You can look at so many different gold and silver stocks. You can look at Newmont Mining. These things have been in nice uptrends and they've broken out and ran higher. You can look at Goldfields as a cheap one. But gold and silver stocks have looked really good. Now, are they buyable here? They're getting extended. You can look, here's AG, another silver stock. The silver stocks really looked good this weekend. And you could see big run, but silver had a 6% move, so there shouldn't be much of a surprise. Another silver stock. Some of the medical device stocks looked interesting, which is surprising. I showed you how weak healthcare has been. This is Medtronic, uptrend, sideways move, and a breakout. Another silver stock, there's that Sabra. Stryker is another med tech stock, medical device stock. Uptrend, pullback, breaking out here. It's a good high-low jump. I can look at it here. It's at 46, so it's not overly extended. We talked about Apple. Wipro in the technology space and kind of a gappy. It's got to be an ADR. It is. Pullback and a big move up on Friday with a gap, breakout momentum. So earnings are out and just met expectations. But look at relative strength, and OBV is turning up. So, I mean, not many of these that I've looked at are bad, are they? Hasbro, not a name that I'm typically going and buying, but we're in an uptrend. Sideways move and breaking out. That's a beautiful chart based upon what I'm looking for. You got a nice base, you got a squeeze, you have a breakout momentum. You're at 61% in the high-low. You're not extended. Not much on relative strength yet versus the spider. You've been going sideways. Your volume looks good. And if you want to see another name that I would never typically be looking at, how about Hormel? I don't like bottom fishing, and this kind of feels like a bottom fish stock. It's got to clear the 200, but you could see the green dots that came in there. So as you could see, there are a lot of good-looking stocks. One that we didn't look at is CCJ. Uranium is on fire. We talked about it, I think, a week ago with some of these new small nuclear reactors that Amazon has worked with Dominion and others to start to work on to supply their energy for their AI needs. And that's going to drive uranium. Can I buy this here with a high jump of 100? Not very easily. I bet it goes higher, but I'll be looking for pullbacks on the uranium stocks. So let's just summarize what we put together. We started by looking at my buy-sell model and that we were in a buy signal on all four of the major indices. We looked at what was working right now. We drilled down into the industry groups, picked out a couple we wanted to look at, the financials for one, and then we did a bottoms-up analysis using the CAT scanner. And then we also looked at some of the large cap tech stocks in the heat map individually. So you got to ride the market that you get. Right now, the market acts like and seems like it wants to go higher. I am worried that we are going to be whipsawed by Fed heads talking about potentially, do we have less of a rate cut coming than we expect? Is it going to be consistent? Is the 50 off the table? And I think that could cause some volatility. And oh, by the way, we're less than 3 weeks from a certain election coming up. So a lot of things can go on to derail this, and therefore my early comment, I'm not in margin, and I'm being careful. And I hope you have a great week in the markets. Again, on a cruise, so not sure how frequently I'm going to do my stocks and docs this week, but I'll be back soon.